Friends, welcome to the podcast series from the School of Fish Strategy Consulting. The topic for today's conversation is Big F.S. in the modern global economy. We have two virtual experts, Mike and Amy, to share their thoughts on the fallacies and failures of the modern global economy based on the research works by Professor Dr. Senthil Kumar. We hope you will find the dialogue engaging and enlightening. Thank you for joining.
Welcome back to the Deep Dive. Today our mission is, well, to cut straight through some of the fog around the modern global economy.
A big task.
It really is. We're diving deep into the work of Professor Dr. Senthil Kumar, specifically his concept of the 6 big Fs that really shape our financial world. And we have to start with the first 3. These are the ones often held up as, well, the bedrock of global capitalism. I want to quote the professor directly and vigorously here. He says, "Unlimited freedom to consume, unquestioned faith in profit maximization, and unchained free markets that has no national boundaries shape the modern global economy, which are the 3 big Fs in modern political economy that is both literally, professedly, and philosophically."
Right. Freedom, faith, free markets. They sound great on paper, don't they? Consumer choice, corporate drive, global trade. They're often seen as the engines of prosperity. But the professor's point, and it's a critical one, is what happens when these ideals mix with 3 other big F's fallacies.
Fallacies, okay.
That's when you get this dangerous combination. The source calls it a deadly cocktail of volatility, instability, and political strife.
A deadly cocktail. That's strong language. So these first 3 good Fs aren't inherently bad, but they become problematic when combined with.
Exactly. When combined with 3 major false premises that have come to dominate modern economic policy, that's the dangerous mix.
Okay, let's unpack those 3 fallacies then. The second set of big Fs. The source connects them to some very influential thinkers whose ideas really shaped global policy. Let me read this quote. "You get a deadly cocktail of volatility, instability, and political strife if you mix these ideals with another 3 big fallacies of unchained, market-driven capitalism, propounded by the renowned thinkers Milton Friedman, Irving Fisher, and Eugene Fama to shape the policies of modern economy." Indeed, these are another 3 big Fs, both literally, theoretically, and technically speaking.
So you have Friedman, Fisher, and Fama. The big Fs, literally and theoretically.
Right. What are their core ideas that the professor identifies as fallacies?
Okay, so first there's Milton Friedman. His principle basically is that the only social responsibility of a business is to increase its profits for shareholders. That's it.
The profit motive above all else.
Precisely. Then you have Irving Fisher. His idea relates money supply directly to prices. Essentially, more money circulating equals higher prices. Inflation is primarily a monetary phenomenon.
Okay, quantity theory of money, basically.
Yes. And third, Eugene Fama. His is the efficient market hypothesis. The idea that market prices always accurately reflect all available information and the true intrinsic value of assets. Markets get it right, essentially.
These are huge ideas. I mean, they're taught everywhere. Friedman's shareholder primacy, Fisher on inflation, Fama on market efficiency. Are we saying these cornerstones are fundamentally flawed according to the source?
Well, the source argues that maybe not flawed in isolation perhaps, but dangerously flawed in combination and in their practical application. The professor states, "One can easily see how these abstract notions on the efficiency of the corporation, money, and markets. Yet, they are yet dangerously, both independently and conjointly, poised against the practical versions of human existence."
Dangerously poised against human existence. How does that play out practically?
Think about the chain reaction. Fama's efficient market idea leads to calls for deregulation. Less regulation lets Friedman's profit-only motive run wild. And to maximize profits quickly, corporations need capital to move faster and faster. This accelerates Fisher's money velocity, but often in speculative ways, not productive ones.
Okay. So efficiency leads to deregulation. Deregulation enables pure profit focus, and profit focus demands speed, which distorts the money system.
Exactly. And that's where the human cost comes in. As the source puts it, the working person gets left shackled in chains, lacking purchasing power, walking through markets full of things they need but just can't afford. It's a stark image.
It really is. Let's dig into one of those fallacies. A bit more Fisher's idea about money circulation, the velocity of money. The source really challenges this idea that money moves at a constant, predictable speed.
Yes, it pushes back hard. The argument is that money isn't like water in a fixed pipe. Let me quote this part. Money does not have a constant speed, nor it produces the same value proportional to its size. Depending on the context or who carries it, money can travel at different rates of velocity.
So the speed isn't fixed. It depends.
It depends entirely. The quote continues. So the time value of money is very arbitrary, subjective, and based on risk propensity.
Arbitrary and subjective. What does that mean for the economy, for people?
Well, think about it. If I give $1,000 to someone struggling, they might spend it relatively quickly, maybe over a month, on essentials like food and rent. That's one velocity.
Okay.
Now, if that same $1,000 goes to a high-frequency trader, it might be used in transactions that happen in milliseconds, generating profit through tiny price differences amplified by volume. That's an incredibly high velocity.
Right. Totally different speeds, different impacts.
Completely. So the source concludes. Thus, it has different outcomes for different people, and in turn, the sources of and differences in opportunity costs are dynamic, disparate, and divergent.
Dynamic, disparate, and divergent opportunity costs. That sounds like a recipe for inequality.
It absolutely is. That divergence is crucial. The source argues that the differences in the opportunity cost of money across places and people can now propel the money to high-velocity locations from low-velocity places, and thus destroying life, liberty, and pursuit of happiness of the majority of people at one end, while decorating the same ideals for a select few at another end. Money flows to where it can move fastest, often speculatively, rather than where it might build long-term value slowly.
And this isn't just about individuals, is it? The source says this applies across the board.
Yes, exactly. It notes, such a disparity exists not only between relatively richer and poor individuals, but also between sectors or firms or nations that differ in terms of creating time-speed value of money. Some industries, some countries, are just better set up to play that high-velocity game.
Which brings us back to inflation. If Fisher's model connecting money quantity to prices relies on this, flawed idea of stable velocity, what does the source say actually causes inflation?
It argues strongly against the idea that giving money to, say, low-income households is the main driver. They tend to spend on essentials where often supply can keep up, thanks to productivity.
So it's not the average person buying groceries that's the problem?
Not primarily, no. The real drivers, according to this analysis, are those playing the high-velocity game speculation, driving up asset prices like real estate and stocks. And crucially, increases in the costs of fundamental inputs, things like energy, transportation, key materials. It's the cost of assets and core supply chain elements, not just general demand from wage earners.
Okay, that makes sense. And this whole discussion seems to directly challenge the trickle-down economic theory, doesn't it? The idea that if you just help the top, prosperity will eventually flow downwards.
It cuts right to the heart of it. The source is quite blunt, stating that the core premises of trickle-down, that markets are efficient, corporations are all-powerful profit machines, and supply-side policies fix everything, are essentially a myth.
A myth. Why?
Because, quoting again, they are inherently inconsistent, incongruous with each other, and inadequate in explanation. The pieces just don't fit together logically, and they don't actually explain the economic reality we observe.
And you can see that inadequacy in the real world, right? Like the example of the U.S. economy.
Absolutely. The source points out that for decades, U.S. GDP growth has been sluggish, often below 3%. Yet during that same time, stock market indices and real estate values have tripled or more.
So the wealth is being generated, but it's not translating into broad economic growth or higher wages across the board.
Exactly. It's not trickling down. The source suggests it's flooding up, concentrating at the top with those who own the assets and can play the high-velocity game.
Which links directly to global power dynamics. The source says your ability to play this game determines your standing.
Yes, precisely. Let me read this. In other words, whether an individual, a corporation, or a nation has the potential to play the high-velocity money game and create more time-speed value of money by earning a foreign exchange determines its power in the international trade and global economy.
So it's not just about making things anymore, it's about how fast you can move money.
That seems to be a major part of the argument. It explains phenomena that might otherwise seem strange.
Like why certain small countries or territories handle disproportionately huge amounts of money.
Exactly, the source explains. That is why the Cayman Islands, Luxembourg, Switzerland, and Singapore has more money than large economies. These places allow very high liquidity and high velocity in comparison to investment places requiring time to produce value.
They're built for speed and not necessarily for slow, steady production. They facilitate that high-velocity game.
Precisely. They're hubs for capital that needs to move quickly, often detached from the kind of long-term investment that builds factories or infrastructure.
This is a powerful critique. But it's not just theory. The professor provides data, charts, to back this up. We should probably look at some of that evidence now so you, the listener, can see this visually.
Yes, the charts are quite revealing. Let's start with maybe chart 8 first, the one comparing GDP per capita to happiness.
Okay, chart 8, what does it show?
Well, you see real GDP per capita climbing steadily upwards over decades. That's the standard measure of economic progress, right? More stuff, more value produced per person.
Looks like success on paper.
Exactly. But then look at the other lines on the same chart. Average happiness, consumer sentiment. Over that same period, while GDP is rising, happiness is flat, or even declining slightly. Consumer sentiment fluctuates, but shows no real upward trend mirroring GDP.
Wow. So the economy, by its standard metric, is growing, but people aren't feeling better off. There's a fundamental disconnect.
A profound disconnect. It really questions whether GDP is the right metric to guide policy if human well-being is the actual goal.
And what about the wealth distribution? Does the data show that flooding up effect?
Oh, absolutely.
Yeah.
Look at chart 4, the one showing net worth distribution over time. It's striking.
What are we seeing there?
You see the share of total wealth held by the bottom 50% of the population.
Yeah.
It's basically eroded to almost nothing over the last few decades. But look at the next group. The 50th to 90th percentile, their share has also steadily declined since the early 90s.
So the bottom 90% are holding a smaller piece of the pie than they used to.
A significantly smaller piece. And where did that share go? Look at the line for the top 1%. It shoots dramatically upwards. That's the flooding up in stark visual terms. It's not a gradual shift, it's a major reallocation of wealth.
Driven by the system rewarding asset ownership and, presumably, that high-velocity finance we discussed.
That's the interpretation presented, yes. Now, let's look at chart 7, monetary and fiscal trends. This adds another layer.
Okay, chart 7, what's key here?
You see the Federal Reserve's key interest rate. It's been kept incredibly low, often below 2% for long stretches, especially after the 2008 crisis. The idea is low rates encourage borrowing and investment, stimulating growth.
Standard monetary policy. Did it work?
Well, look at the other lines. U.S. debt to GDP ratio, climbing relentlessly. Government spending to GDP, also trending upwards. But what about actual GDP growth? It remains sluggish, hovering around that 2-3% mark we mentioned earlier.
So cheap money isn't necessarily translating into strong, real economic growth. It seems to be fueling debt and spending without fixing the underlying sluggishness.
That's the picture the data paints. It suggests the traditional tools aren't working as expected, perhaps because the money flows into asset inflation or high-velocity speculation rather than productive investment, reinforcing the cycle described by the 6F's critique.
And finally, there's a chart on global finance, right? Chart 3.
Yes, chart 3, showing cross-border holdings. It visually maps out where global capital resides or flows through. The total figure is enormous, $81.26 trillion.
And does it highlight those high-velocity centers?
It really does. You can see jurisdictions like Luxembourg, the Cayman Islands, Switzerland having an outsized role, holding or channeling vast sums of money, completely disproportionate to their actual size or productive capacity. It visually confirms their role as hubs in that high-velocity global money game.
So, putting it all together, the data seems to show an economy growing in aggregate terms, GDP, but with declining well-being for many, dramatically increasing wealth concentration at the very top, persistent sluggishness despite low interest rates, and a global financial system dominated by high-velocity hubs.
That's a fair summary of what the charts illustrate. The aggregate statistics we often rely on, GDP, inflation rates, they seem to mask these deeper, more disparate realities. The system appears to be working according to the rules of the fallacy Fs, but the outcomes aren't serving broad prosperity.
It's a pretty sobering analysis. But the source doesn't just leave us there, does it? It talks about a way forward.
No, definitely not. Despite the strong critique, the tone shifts towards actionable optimism. The core message is that these are norms and rules that humans created, and so humans can change them.
We need an overhaul.
A fundamental overhaul. Across corporations, markets, the money supply itself. The goal should be to moderate the interests of all stakeholders. Not just shareholders, but employees, customers, communities, the environment, government, everyone involved.
A new balance, as the source material sometimes put it. What would the key components of that be?
Well, it emphasizes three things. First, a focus on sustainable production and consumption, particularly of essential goods. Moving away from unlimited consumption as an ideal.
Okay, sustainability.
Second, equity. Real equity across all layers of society, addressing that flooding up effect and ensuring opportunities are shared more broadly.
Equity. Makes sense.
And third, inclusivity. making sure policies consider populations across nations, not just within borders, and certainly not just benefiting the few who can play the high-velocity game.
Sustainability, equity, inclusivity. It sounds like a comprehensive reset of priorities.
It would have to be. It requires rethinking those foundational Fs, maybe aiming for fairness and functionality over just freedom and faith in unchecked systems. And this brings us to maybe a final thought for you, the listener, to chew on. If we accept the argument that power for individuals, companies, even nations, is currently tied to playing this high-velocity money game,
Yes.
then the provocative question is, how can we consciously redesign our economies local, national, global, to inherently reward value creation that requires time and stability?
How do we make building things, educating people, strengthening communities more valuable, more powerful than just moving money quickly?
Exactly. Can we engineer a system where patient productive investment consistently outperforms rapid speculative liquidity? That seems to be the central challenge posed by this analysis.
That's a huge question, but a vital one if we want to move towards an economy that truly serves human well-being for the many, not just the few. A fascinating and perhaps necessary new deal for the modern world. Thank you for joining us on the deep dive as we unpack these complex ideas. We hope it gave you plenty to think about.